Hello everyone, my name is Juan Sarmiento. I'm the founder of Put Code Genie. Today, I'd like to tell you about our specialty, the Genie Trade. In June this year, when I was first asked to participate at the Traders Expo, I thought about a title for my seminar, thinking that the market was hitting new highs and that the bull market that started back in 2009 will soon come to an end. The problem is, no one could possibly know when that is going to happen. Months later, here we are. The markets are still hitting new highs. This observation begs the question, are we in a bubble? Let's look at the evidence. I have been a student of the Elliott wave theory since 1995, and I believe that this is the closest thing we have to a predictor of the market behavior. But I have to admit, after all these years, that many think that this predictive value is questionable at best. Let's see what you think. Since its birth in the middle of last century, the S&P 500 has formed what is known as an impulse series that includes 3 waves in the direction of the trend and 2 corrective waves in between. Based on their duration and their magnitude, we are going to call these 5 waves cycle waves. And they all form together a larger single supercycle impulse wave that is near its end. We are currently near the end of the 5th cycle wave, which will be followed by a long-term supercycle bear market. In order to estimate where the supercycle bull market comes to an end, let's take a closer look at waves 3, 4, and 5. Using Fibonacci extension tools, we can compare the 3rd wave and the 5th wave in price growth. Now that the 5th wave has already exceeded the 3rd wave by nearly 38.2, means that the 5th wave is the extended wave, and it should reach 161.8 of wave 3. The S&P 500, therefore, has a target of around 3,000 points. Using the Fibonacci time extension tool, we see that the 5th wave has taken only 50% of the time it took the 3rd wave to complete. Now let me remind you that the last part of the 3rd wave became known as the dot-com bubble. So considering that the 5th wave has already exceeded the growth of the 3rd wave, we can say with certainty that we are in a bubble territory, and that when the end comes, it will be a rapid and painful reversal. Using the Fibonacci extensions, we can create a grid to fine-tune our targets. Let's take a closer look at this grid superimposed on cycle wave 5. This cycle wave 5 started in early 2009 following the financial crisis and the beginning of the Obama administration. Based on that information, my target is this cyan color arrow. Keep in mind that bubble markets expand quite aggressively towards the end, and many stocks may reach unexpected highs. The Elliott wave theory is based on fractals, so the 5th cycle impulse wave is formed by an impulse series of its own. These are the 5 primary waves here in yellow. Once again, using the Fibonacci extension tools for time and price, we can project the end of the 5th wave. This should be more accurate than the cycle wave analysis that included data from decades ago. My corrected target is 35.24, pointed out by this yellow arrow. Now let's zoom in to examine primary wave 5. This primary wave is divided in 5 intermediate waves. And as you can see, wave 3 seems to be still in progress. So we need to see a small correction of wave 4 before we can project intermediate wave 5. So as of right now, the target is not precise. All we can say is that the S&P should exceed 3,000 and approach 3,500. So let's make some conclusions based on this information. We are definitely in a bubble market with price growth that exceeded the dot-com bubble in half the time it took to complete. The end of the bubble may be strong, and some stocks may exceed all expectations before they find their top. The end of the bubble should occur after 3000 is reached. This target will be the end of the fifth intermediate wave, which in turn will coincide with the end of the primary wave and the end of the fifth cycle wave. And this should occur soon. Following that, we will have the beginning of a bear market supercycle. So what is ahead? An aggressive short-term bull market and a rapid and painful reversal, and eventually a long-term bear market. How do we profit from a market bubble? If we follow the old cliche, buy low, sell high, this would be the time to sell, don't you think? However, as traders, we have much upside to take advantage of. Let me go through a few possibilities. You may look for stocks that are at their 52-week lows and buy stock whenever you find value. Let's use UA, Under Armour, as an example. But let's face it, the pressures of the markets will affect these stocks too. Buying stock is a good idea if your time horizon is large. If you're young and have all the time in the world, buying stock is an attractive proposition because the potential profit is unlimited. However, if you take a look at the collapse of 2001 and that of 2008, you may lose as much as 50% of your stock value in just a few weeks, and recovery can take a long time. Significantly, your cash outlay is rather large. We should really think short term, let's say 2 to 3 months ahead. With options, you have both leverage and risk management on your side. Buying a call gives you a profit potential similar to 100 shares of stock, but the potential loss is limited to the cost of the option. The cost of the option is only a fraction of the stock price. Unfortunately, because the break-even point is well above the current market price, the probability of profit is rather small, about 34.53% in this case. It is possible, however, to make a good profit and exit the trade long before expiration, but the probability is still low anyway. If you are caught in a market reversal, the only protection here is the limited cost of your trade. At least you know in advance how much you can lose and plan accordingly. You can increase your probability of success by entering a covered call. This is the simultaneous purchase of 100 shares of stock and the sale of a call option. In this case, the current price is well above the break-even point. So your probability of profit is high, 61.23 in this case. Unfortunately, the market loss is only slightly less than buying the stock, while your potential profit is limited and small. A covered call won't be much protection if the stock declines quickly and strongly. And you still need much cash in order to buy the stock. The short put is the synthetic equivalent of the covered call, with similar low break-even point and large probability of profit. However, the potential loss is equivalent to owning the stock, and your potential profit is also small and limited, as in the covered call. But what if the stock has already have a big run-up? Here is Baidu, for example, for that situation. To keep your probability high, you could sell a naked call. The break-even point is well above the current price, and the probability of profit is high, 64.4% in this case. But as I said before, the end of the bubble will surprise you as to how high a stock can go. By selling calls, you obtain a credit, $1,275 in this case, resulting in unlimited potential loss. Your broker will allow you to make these trades by keeping 5 times of the capital of the credit that you receive in this trade. But you can get margin calls if the stock continues its massive run up. Fortunately, in this case, Baidu declined strongly, but the risk is unnecessary. Now look at this strong decline as an example of what could happen with a high flyer like Baidu. Such moves are more or less unpredictable. With the right trade, this may actually be a blessing. Keep that in mind as we discuss other option trades. With the naked call, it matters little whether your stock goes down 10, 20, or $100. Your profit is limited to the credit you received. Let's look at the UA chart again, with one more important detail, the implied volatility. You can think of implied volatility as the demand for options in an underlying. The implied volatility is an important component of trading options because high implied volatility means that your options are expensive and you want to sell expensive options and buy cheap options. You can enter a vertical spread to reduce the effect of high volatility, since you are buying an option and selling another. Here is the current stock price. Selling an option lowers the break-even point and thus increases the probability of profit, 54.71% in this case. While we can limit our potential loss, it also limits our potential profits. Whether IV is high or low, vertical spreads are basically the same thing. A variation of the vertical spread is the call diagonal. In this case, the option we sell expires first. Here again, the break-even point is below the current price, so the probability of profit is high, 67.53 in this case. The potential gain and the potential loss are both limited. Notice that if the option you're selling has a higher implied volatility, the trade can be quite favorable. Both the vertical spread and the call diagonals are not the greatest for the market conditions we are expecting. If the market rallies strongly, we have limited profits. And if the market suddenly declines, we can lose all of our investment. But be patient, we have other alternatives still coming up. At Putcode Genie, we limit our trading to high flyers in very specific volatility conditions. And that is our game plan. Take, for example, IBM, which jumped more than 10% after earnings and implied volatility decline near a 52-week low. Ideal for low volatility conditions is the CRC, or call ratio calendar. This is very similar to the long call, except that the break-even point is lower than the stock price. Here, we sell one front-month option call and we buy two back-month option calls. Note that the volatility must be low. That is, it must be below 40%, and it must be near the 52-week low. Done properly, the probability of profit will be better than 50%, 56.52% in this example. Just like in the long call, your profit is unlimited and your potential loss is limited. A CRC can be any ratio that you'd like, as long as the number of long calls is greater than the number of short calls. In this case, it's 3-to-2. Notice that the break-even point is lower still, and therefore the probability of profit exceeds 60%. If you are bearish, you can also buy a PRC, or put ratio calendar, which is similar to the CRC, except that you switch calls with puts. The number of long puts is always greater than the number of short puts. In this case, 2-to-1. Here again, implied volatility must be low, and the probability of profit is high. 57.65% here. All trades that we have discussed here are a compromise between probability of profit and profit potential or potential loss. None of them are ideal for the situation we are expecting, which is the bursting of the bubble after an expansion to unexpected levels. Our method again is to look for stocks that jump significantly or that are established high flyers. Take Cree as an example. The stock jumped more than 10% after earnings and the implied volatility declined. When we combine a call ratio calendar with a put ratio calendar, the resulting trade has a break-even point that is near the current price. Delta is positive, which means that we are going to make money when the stock goes up. Critically, implied volatility must be low because if the stock goes down as the bubble bursts, implied volatility will go up, and this favors our trade. Notice that Vega is positive, 26.31 in this example. That means that we're going to make $26.31 with every 1 point increase in implied volatility. And you can count on implied volatility exploding when the bubble bursts and even before. This trade, folks, is what I have named the Genie Trade. Just to be clear, the Genie Trade has 4 legs that can be executed as one single trade. You buy 2 back-month calls and 2 back-month puts, both at the same strike price and with a minimum of 90 days to expiration. In the front month, we sell 1 call and we sell 1 put, both at the same strike price as your long calls and puts. As I said, the resulting trade will be done for one single debit. In this table, we can see the ways you can make money or lose money with the Genie Trade. If the stock increases in price, volatility tends to decrease, so we make money by virtue of delta gains. This is typical of bull markets. If the stock decreases with declining volatility, we may lose money, but the low volatility indicates that we are in a temporary correction and the stock may go back up again. And in such cases, it is best to hold the position until profitable or near expiration. If both stock prices and the implied volatility increase, is a very beneficial and rare situation. This may occur when a company is about to report earnings and the sentiment is quite positive. If the stock declines strongly, volatility also increases. This is one of the best outcomes, and it is common in bear markets. If the stock goes sideways, the short options lose value and the trade may turn a relatively small profit. In summary, the Genie Trade benefits from volatility increases. It benefits from strong stock movement either up or down, which makes it an excellent trade for our forecast of a bubble expanding and then bursting. Sideways motion will produce a small gain as the value of the front month options erode as they approach expiration. Declining volatility will hurt the Genie Trade, so we pick stocks with low implied volatility situations and are ready to exit the trade when implied volatility is too high. Let me take a break here to suggest that you visit Put Call Genie for additional information. Be sure to watch 2 videos available in the front page, one entitled Trade Once a Week and the other Sleep Well at Night. This will give you more details about the Genie Trade. Then zero in on the free videos button for additional videos regarding the performance of this trading methodology. Please be sure to register as a visitor as you get additional notifications of videos and articles about options trading. Now let's look at additional samples of stocks that could be Genie Trade candidates, starting with Apple. Note that implied volatility cycles, rising towards earnings and then collapsing right after earnings. Apple, the stock, has been going up in advance of earnings, and volatility has spiked up as well. This is probably the best situation because you have both delta and vega gains. But don't wait until after earnings to take your profits because implied volatility may collapse, and also can the stock price. Recently, we had a spike in Adobe's price with a big gap. But also, that occurred months ago. Let's take a closer look. After a gap, the stock may take off, but it also may correct to fill the gap. See how the implied volatility spikes along with the decline on the stock price. Of all the trades we have discussed, the Genie trade would be the only one in which you would profit from such situation. More often than not, a gap up is followed by a bull run, and that may happen more than once, as in this example of Nvidia. You see the strong run up after the first gap after an earnings beat. Gaps like this are most common after earnings or after some important news that suggests increase in earnings expectations going forward. Read the news and see if the jump is justified, as in this example of ANTM. Note the decline of volatility after earnings. Note the spike after earnings in Celgene, and then again a breakout later on. Eventually, though, a high flyer will correct, but the Genie trade will give you additional profit if that happens. That is, if you have been taking profit with your calls. The put side of the trade will become profitable too. Netflix is the stereotype of high flyers. Note the gaps after earnings and followed by big rallies. That's all for today. Thank you very much for joining me.
What are you waiting for? If you are ready to learn this powerful approach to options trading, please go to putcodegenie.com and locate the appropriate button and join us today. Also, feel free to subscribe to this YouTube channel by clicking on the subscribe button. Thank you.